Hello, it's Tim Moffat, the portfolio manager for the 18.6 Strategic Investment Portfolio. I'm here with Akhil Patel, our co-investment committee member. We're just going to do a quick end of quarter summary and stock take after early January now, after 2025, which was a pretty fruitful year for us and our investors. December quarter, we finished up 9%. Which was materially ahead of the MSCI World Index, was up 3%, and the All Ords was actually down 1%. Had some reasonable amount of weakness in the financial services here, which are a big chunk of the index. So over the year of 2025, the portfolio was up 46%, which was more than double the MSCI World Index at about 20%, and the All Ords, which was under 10% gain. So in the December quarter, it was really our precious metals and copper exposures that drove a lot of the outperformance. So what became one of our biggest holding was physical silver, which we purchased earlier in 2025. That was up 54% in the December quarter, which was obviously quite a material gain. We hadn't sold any silver on the way up. We've really been holding on to it, while it's been in quite a strong trend, but on the last day, a trading day of the year, we did take a little bit off the top, take some profits off the top, and lighten our holding. The second best performer was Firefly Metals. It's a copper developer in Australia, high-grade copper resource. It's actually a new addition in the portfolio, and that added 39% in the quarter. The next best performer was Sandfire, which is the largest listed copper company in Australia, up 23%. And a similar theme here. The next best performer was Global X Copper Miners ETF, which is basically a basket of the largest copper producers. That was up over 20% as well. And then finally, MNRS, which is global gold producers, was up 15%. So between all those holdings, which over the last 6 months have become reasonable size positions in the portfolio, that generated a big chunk of those strong quarterly returns. Now, in terms of stocks that have been added during the quarter, we bought some Rio Tinto, an old stalwart in the Australian market. That's probably performed well on the back of copper prices as well. Iron ore price the last few years hasn't done a whole lot, has shown a little bit more positive momentum, but nothing compared to precious metals and industrial metals like copper. But that's a good business, so we've added a starter position there. We've also added some European exposure with ESTX, which is a top 50 Euro ETF. And we added back some QHAL, which is basically a global basket quality stocks, which has been slowly trending up in the background. So in terms of what we're seeing now and looking into 2026, we've really seen something of a stalling in US property prices, which for everyone who follows the real estate cycle is obviously pretty important metric to be across. Akhil might touch on it, but we're coming into 14 years from the low in 2011-12. So that's something to certainly be watching for. We've seen probably a pretty material high in the US builders, which have a history of topping before the market. We've seen continued increase in margin lending and ETF leverage, and we've also seen inflation re-emerging across the world as a bit of an issue. So we think the rates, while the talk of the town at this point is the Fed lowering interest rates, we think that there's continued possibility and risk that rates, might surprise to the upside, which could give the market, food for thought or pause. So, look, we think it's very unlikely that 26 repeats the way 2025 did. There are now substantial risks building into the market and the system. We are cognizant that the market continue to trend, and if so, we're just doing our best to capture as much of that as possible. But I know Akhil's just, with Property Share Market Economics, and Phil just released their 2026 roadmap. Might be a good opportunity just to talk about what you guys are seeing from a real estate cycle perspective.
Yeah, thanks a lot, Tim. Really good 2025. We expected it to be an up year. and I'm very pleased to see that we've captured a very substantial portion of stocks that were appreciating value. I suppose principally in the resource space, which is exactly what you'd expect at this point in the cycle. In other words, there is a global build out. There are sort of concerns about what's going on in the financial system. And so kind of industrial metals, precious metals are appreciating in value. There's still plenty of credit creation going on around the globe. And so some exposure to financial stocks has been, kind of pretty good for the portfolio. Now into 2026, there is a very significant degree of momentum behind the market. So as you say, we'll position ourselves to continue to ride that. There are risks building in the system. I mean, there are always risks building in the system. I think some of them are now relatively substantial. One thing I would say is that they're relatively well known about. So a lot of people are talking about the build up in private credit. They're talking about the concentration of US markets in the Mag 7 and AI related stocks. They're talking about the enormous investments that AI companies are making and whether they can achieve an adequate return on investment. And that's providing some level of concern. We are indeed exposed to relatively high long-term bond yields. I think the US government would ideally like to see them come down, but they seem to be relatively stubbornly high, which is one of the reasons why the yield curve in the US is steepening, which is not a particularly good sign at this stage of the cycle. And so the outlook for 2026, I think, is a little bit mixed. On the one hand, you have the momentum, as I've said, but on the other hand, we are late stage in the cycle. We know what comes next. It's outlined in Phil's book and in my book, potentially 3 or 4 years of relatively difficult economic and financial situations. And some of that is reflected in the data. But, our sort of investment case has always been you follow the risks, you manage the risks, you don't kind of overdo the sort of leverage and overdo the sort of the amount you're putting into markets. You're prepared to run relatively tight stops if you're a trader, but until the market gives you the absolute signals that the trend is down, you remain relatively invested.
Good summary of where we stand at this point. So at the end of the quarter, we had cash of about 26%. Most of the quarter, despite the strong returns for the portfolio, most of the quarter it was sitting at around that level. So it's there's a degree of capital preservation in mind, but brought by and large, we're still pretty fully invested at this point. Fantastic. All right, I think that's a great snapshot of where things stand going into 2026. Let's see how it unfolds. Thank you very much. If anyone who's not an investor would like some information of how to invest, please contact us on the website, oakleighfs.com, or you can email admin@oakleighfs.com and request some information. We'll come back to you. Thanks very much, Akil.
Thank you.